Thank you. Welcome to FACE, and I'm passing you the presenter ball. So looking forward to hearing your voice. Oh, and you even have a screen for us, Brynne.
I do.
Oh, fantastic, because I wasn't sure. We didn't talk about that. So everyone, this is Brynne Kelly. You could follow her at Brynne Kelly. And Brynne, thank you so much for taking time out of your day. We're going to get you out of here before the oil report. I know that's big for you in about a half an hour. But I'd still like you to get into a time machine with me. I read about all the different brokerage firms, commodity firms you were with during your career. Can you take us back to what it was like, how you got involved in the business, who were your influences or books or mentors that you had developing into what you are today as an oil analyst?
Sure. Well, first of all, thanks for having me. I have been a career trader. I came into it a little bit non-traditionally. I started out of college with a finance degree and started working at Cargill in the mid-office. And really that's kind of where my love for the trading business came from.
Where was Cargill? Where was it in Chicago?
Minneapolis.
Oh, Minneapolis. Okay.
Yeah, the headquarters. Yep.
Okay.
Yep.
Okay.
So I was young, right out of college. I didn't know anything about trading. My father was a CPA, so that was really the extent of really what I knew.
He must have been very glad about your decision to get into the commodity business.
Not really. He really was more interested in me coming into his business.
I know. What my mom said to me when I went to the Merc and I was a runner, out trade clerk, and then Series 3 guy, honey, please find a real job. Yeah,
I mean, certainly was, like I said, it was a big corporation with, a particular career path. And like I said, I didn't start in trading. My first job at Cargill, I just happened to be placed in the trading business. You generally got placements after you went through some training. And I ended up getting placed in what was called then their financial markets division. And so that's when I really fell in love with it. And
how fortunate, Brynne, how fortunate of you to start that way compared to what people, the big clearing firm jobs in-house, they're just not there anymore for young people coming into the business. They get bamboozled on the internet and social media. So I'm sure you appreciate how fortunate you were to break the ice with a very influential high-end commodity firm like Cargill and getting placed in trading. So fantastic.
Yeah, I mean, it wasn't commodity group, it was a financial group, and they traded baskets of stock. And it took me about 6 or 7 years to ultimately get my first trading job. People probably have experienced that there isn't a lot of movement from the mid office to the front office. So I ended up moving around and trying to position myself at various firms. And I ended up in the early 90s as the controller at Koch Supply and Trading in Wichita, Kansas. So I was at their headquarters.
Okay.
And
so
then
you were handling hedging for them. They were a commercial commodity firm.
Well, I was the controller, so for the supply and trading group. So again, I still was not trading. Okay. I was, responsible for all of the financial reporting and whatnot, and staff and everything that goes along with running a business. Still trying to get myself onto the trading side, and finally, my break happened. I was talking with a firm in Kansas City right when the electricity markets were deregulating.
Oh, Enron days.
Pardon me?
Enron days.
Correct.
Okay.
And so there was a utility in Kansas City, not Kansas City Power and Light. It was called Utilicorp, and they were starting up an unregulated electricity trading group. They already had a gas trading business, and so they were adding to it. And so I was one of the first 3 or 4 traders that they brought in. And that's when I really got my lucky break. The head of this new business basically gave me a shot. And he gave me that shot because of all of the background that I had within the trading business for all those years. It wasn't really a traditional move to go from being a controller of a firm to being part of a merchant energy group. And I really think that's the big differentiator is in deciding about trading jobs is taking a look at the merchant side of the business, because that's really where you can form a career. Yes. And get enough knowledge about the commodity you're working with that will have incredible value for you in the future.
For the rest of your trading life.
Correct. Right.
Okay.
Moving the logistics of the business, moving around. And so from then on, I spent my career in merchant trading firms like BP, Sempra, Aquila, trading electricity, natural gas. And then I was at a hedge fund in New York called Millennium, where I traded electricity, natural gas, and crude oil. So wow. It's been very, very good fundamental experience to have. And within a merchant business, what you're really focused on is the logistical opportunities that the futures prices present to you.
So like arbitrage opportunities between cash and futures? Spreading opportunities?
There's not really an ARB between, there's an ARB based on location. Yeah, around the country, right? So WTI is just one price, like crude oil. WTI crude oil is just the price of crude oil at Cushing, Oklahoma.
Okay.
And then there are hundreds of other products and futures and over-the-counter swaps that trade all sorts of various locations, right? Crude oil in Houston, crude oil on a barge, crude oil, there's logistics, and essentially you're looking at the spreads between the various markets and employing your logistical capabilities, whether you own pipeline space or you have the ability to buy pipeline space or you can charter a ship and whatnot. And you're taking advantage of quality spreads and location spreads.
Did you ever handle a hedge account for the Clampetts in Beverly Hills?
I never managed outside money. I always traded money for the firm. So for example, when I was at BP, right, you're a merchant trader for BP.
Right.
So
they're not
outside investors.
Yeah, it was just a joke that you're so much younger than me. You're so much younger than me.
I don't know that.
I don't remember the Beverly Hillbillies, they struck Jethro and his family struck oil in Beverly Hills.
Okay. Well, I remember. Yeah, okay. That might be just a few years before me, but not very many years.
I told you we'd have fun. So, okay, so here we have the WTI curve shape. So explain to us what you're seeing here with your dotted lines, green and white.
Sure. Well, there's a couple things going on in the crude markets. And I guess I want to first start out by saying that my trading style, it seems to be a lot different than, what I see from the typical conversations out there. And it has to do with my experience and where I'm comfortable. So right. These are the types of things that I look at, and the type of trading I do is rarely technical. And it is not a statement against technicals. I appreciate them. I look at them. That's just not where I get my confidence from when I set up a trade. I'm much more interested in how all the pieces fit together. And I might only take a trade in a particular location or commodity once a month, once a quarter, or every day. It really just depends. I'm looking more for playing out a longer term scenario. So.
Okay. Well, Jack Schwager said, I've interviewed him a few times, and I asked him, what's the most important thing for a trader? And he said, find a trading style that suits their personality.
Exactly. Right. Because the most important thing is that you have conviction.
Yes.
And I don't have conviction trading against computers. That's just not my thing. My belief is that I can't buy enough advantage to go against all of the programmatic algorithms that are out there that have co-location and high speed and a group of people, PhDs and psychologists and applied mathematics looking at behaviors. That's not where I want to compete, because number one, that's like going to Vegas. I mean, I don't have any odds on that.
Let me ask you this, Brynne. Do you think it's more difficult to compete against algos than it was from locals in open outcry?
Yes.
Okay, great. I value your view on that because I tend to agree. So,
well, because of course locals, that just was not, unless you were there.
Yeah.
Let's just say there's many more people to trade against than there was. You could take the example of the local group, right? It was a fixed group.
Yeah.
Of people.
How many? Like 50 guys in the oil pit at NYMEX.
Correct.
Okay.
So that now it could be 50 million. You don't. Right. You just don't know who and what is out there and how. I think of it like advertising, how kind of twisted it is in the types of things they know that resonate with people.
Oh, subliminal stuff. Like
pumping in cents into a grocery store, all those things, right? That's not where I'm at. So that's number one. I just wanted to get that out there because I think it seems like a lot more people are interested and have many more talents than I do in that. So what I look at, and I have this particular chart up here.
We do.
So I kind of start in one place and dive down. So quite obviously there's the benchmark crude contracts that trade, and there are three. There's WTI, which is US, there's Brent,
right, which
is sort of covers Europe and whatnot, and then there is the Dubai or Oman contract, which is Middle East. Okay. And those are the three main crude oil strips and futures contracts that trade, and everything else, most other crudes are priced as a spread to these contracts because there are thousands of grades of crude oil that are trading out there. So I'll start with, I live in the US, so I generally start with WTI. And, time is a nice thing, right? So if you go back and you look at charts over time, I have obviously since April, and I'm kind of taking a look at what the 12-month strip has looked like since the beginning of April. And the reason I chose April, and I do for a lot of things, that there's a seasonality to all commodities. Okay. Some have more, some have less. And crude oil itself isn't necessarily a seasonal commodity. However, its end use products are. And I consider summer to be gasoline and winter to be distillates and heating oil.
Yes.
So
Okay,
and therefore the inventory, numbers and trends that you like to see are related to those seasons. And I'll show that in a second. But just to get oriented, right, you can see that at the beginning of the season, or in April, the curve was pretty flat. We even got to a little bit, maybe even backwardation further out in the curve, but it was pretty flat. And flat curves can tend to rise and fall together.
Yeah, there's no message like there is in a carrying charge market or backwardation. Right. There you have a message of near-term demand or just carrying charges, normal carrying charge market.
Sure, and this was the market, sitting before the season had really started and had been absorbing the OPEC cuts that had started at the beginning of January. Right. So it was still a little bit in a wait and see mode. And then the first inventory numbers started to come in. I mean, it's not like we don't have them every week, right? But they start coming in for the beginning of the driving season, and the whole market just got nervous. And really, as happens in most commodities, you see this in natural gas as well. You get like one day into the summer season or the winter season, and if you don't get the most bullish number, the market just throws in the towel. So at the beginning of the season, we saw people were waiting for gasoline inventories to draw down.
Right.
And they weren't.
Yeah.
So it just fueled the bearish sentiment and the oversupply and the glut sentiment that's out there, and which continued, into June. Although then we see a little bit of curve shape start to take hold, and now it kind of brings us through to today, right? And yes, we can see that we've taken all of the backwardation out of the market, and we have a whole bunch of carry. Now, if you look at this chart right here, is basically showing what the 1 month carry was.
Okay.
So each month is just Augie, Sep, Sep-Oc, Novi, right? It's just each 1 month roll. And at the beginning of the year, you could see that once you kind of got a few months out, the market was 1 month, it had gone into backwardation. And it was a very slight contango. And then you kind of get us to where we are today, right? And the entire curve all the way out for 12 months plus is in carry. So the effect of that was, if you're, when you're producing, you have a choice, right? You either put it in the ground or you sell it into the market. And once, like a 6 cent, even these carries are a little bit more, 21 cents and 17 cents. But in reality, it does cost about 15 to 20 cents to carry a barrel from a month, from one to the next. And then you have some added costs and some risks. So when the carry gets, narrower like this, really you can expect more barrels to just be sold onto the market. And that's what we see here in this curve, right? There was really not a lot of incentive to hold the barrels, which just weighed the whole front of it down. Because you can see here, the back now is starting to hold on.
I see that. Okay. So during these different phases, you're making decisions on directionals, or just taking advantage of something like knowing how the curve is going to go in that implies what price might do?
Yeah, so I will trade spreads, so calendar spreads, right? Based on this
Okay.
signal right here, right? I would have been a little more interested in trading the front versus some of this back. A popular spread is the DEES spread, right? The front December versus the back December. It had almost gone into backwardation earlier in the year. And that was certainly the narrative around OPEC cuts aren't going to carry through beyond the middle of next year.
I see.
So the market will get tight and then it will loosen up.
Okay, so more constructive. So you'd be long front month D, short 1 year out D's.
The other way around. Short the front month.
I see. Okay. And
relative to the back.
Okay.
And only because, you know, based on inventory levels, I believed that the shape of the curve was actually going to get a lot more, it was going to come under a lot more pressure in the front because there was not a lot of carry. The market was going to be selling out barrels into the front of the curve, but prices at 40 some dollars in the very back, 45, that doesn't bring a huge call to action, right? Above $50, you could expect producer type selling. And that's kind of where we were on the curve here. But once you get down to 46, 47, $45, not as many people are dying to lock in a sale there. They'd be more interested in maybe buying some puts.
Interesting. So I saw a tweet by you, Brynne, and it had euro with exclamation points. Do currency movements play a role in your decision-making process? Weak dollar, strong dollar?
Not usually. However, there are periods of time. I remember, was it 2007, 8, or 9? Yes. The euro was falling, correct? Or was it, whichever way it was going, crude oil was the complete inverse. And right. Of course, when we hit, I can't believe I can't remember which way.
It was a strong dollar that took gold down from its peak of 140.
Right. Yeah. So a strong dollar makes it difficult for everybody outside of the US to purchase crude oil, right? Because they need to buy it in dollars.
Right. Do you see any potential correlation, since the dollar is a petrocurrency? Like right now, crude's bounced, but in generally, we've had a weak dollar, and besides this recent bounce, generally a weak market. Could less demand for crude equal less demand for dollars?
I wouldn't say it that way, but I will say if it reaches extremes, because I think during the time period, 2008, let's just call it, I think it was 85 cents or something, that or below $1, right? That the euro got to, and that was an extreme, right? And so that's why it was so correlated. Right. So I would say that if the euro,
only when the rubber band is stretched in a big way.
Okay. I mean, because for the most part, I mean, I know people get excited about, and there are interesting moves that, you know, the dollar, euro, and other currencies have had. They're not really outside of any ranges that we've seen.
Yeah, all correlations have been breaking down all over the board recently. Let me ask you this, being an energy trader and having been around for a while, you keep one eye on geo risk, and I know there's some people that are, you know, it's a forecast, and they think that there might be some type of problem in the Strait of Hormuz how much risk premium would be put into oil if there was a problem in a skirmish with Iran, do you think?
You know, that I would, geez, how do I answer that? That if that happens, that happens. I don't believe there's really anything priced in to this market. If anything, I think there's probably a huge bear discount priced into the market. You know, there are a lot of the logistics of the crude market have gotten to a point where you know, we have a lot of cushion. And let's see what to, let me make that example a little bit more. So I don't know if you can see right here. One of the things that has happened over the last several years is this first section is the crude oil stock levels. And the second grouping here is the US storage capacity. And most of this is in the US Gulf Coast because that really has become the major hub, right? It's where over 50% of the refineries are. You know, we now need to make space for exports and you need additional capacity for that in order to have crude coming in and going out. You have to have different tanks and different pipes. And so over the last several years, yes, we have added to crude oil inventories, and you can see how our stocks have grown. But we have also significantly increased our storage capacity. So it would be to think that we would add extra capacity and just leave it empty. You know, that wouldn't be very optimal, right? It would make that capacity pretty expensive.
Build it and the oil will come.
Right. And so to look back at, you know, I see people do a lot of comparisons to 5-year inventory levels, and they might, you know, just take a look at, you know, look 2012 and look how high we are now. You know, at some level, the system has expanded. We've added pipelines. Pipelines need to be filled, you know, and that crude goes away forever, right? Because it's in the pipeline. We add tanker capacity in the Gulf Coast. We've added a lot of capacity that's working. And this is considered working storage capacity. So we're now just at a new level. And I don't know that I would say the new level equals bearish more than I would say the new level equals lower volatility.
Interesting. Okay.
But the lower volatility is for crude oil, right? I mean, a barrel is much easier to get at if it's pumped out of the ground and sitting in a tank. You can get to it much quicker than if you have to go rush and pump it out, right, for some sort of emergency.
Right.
It looks like we just had the crude number there.
Okay.
So anyway, so I look at it as these upside scenarios, such as Iran or whatever you're talking about. We've reduced the volatility on those events because we have.
Even if we liquidate the strategic SPR, it's really not good. What is that? Just a token gesture, or what do you think is behind it? We don't need it. Same philosophy.
So from what I've looked at from the sales out of the SPR, they have been primarily sour crude, which would make sense because the OPEC cuts were primarily medium sour crudes.
I see.
So, and refiners in the Gulf Coast are geared towards running medium and sour crudes. So I'm not sure so much, you know, I think it was a smart thing to do, right? I mean, might as well take advantage of this tightness in these more heavier and more sour crudes while, you know, the market is a little bit more tight of them.
Okay, well, must have gotten a constructive number. I see crude firming up. Any view that this range is $20 range or $15 range we've been in? It feels like for years. I know it's only been about 8 months. You have any biases, or that's not your game?
Okay, so what I would say on that is I see us being stuck in this range for quite a while.
Okay, like the bonds.
And I'm not that interested in catching crude from like 46 to 47, right? Or 47 to 48. I would be a little more biased to an upside picture, but I don't mean, let's say holding even. But really for me, I don't really care if it's 44 or 48. I'm not really, I don't get that much bearish, beyond that, because if you take a look at, and there may be new evidence that changes my opinion, and that is
Right,
certainly
always.
what I'm.
It's a process. Yeah, you're always reassessing.
Yeah, well, because we have drawn, so this chart right here is since April, as we were talking about April,
Right.
in the past several years, here's how much we've taken out of, or the inventories have changed. And so far this year, and I don't have today's number added in, so we've taken around 53 million barrels. And you can see that, I mean, we're not even close. We're far above anywhere last year.
Right.
You sort of expect that we would build heating oil inventories because that's what you do in the summer. You build
Right.
heating oil for the winter. And you would sort of expect that you would, draw down some gasoline, although, that's what they're mainly producing.
Yes.
So from this picture here, unless if this were to continue, at this rate for the end of the year, I mean, the picture gets a bit less, bearish. This glut narrative, really, it's not real, it's perceived. I mean, it's real that we have more in the ground, but a glut would imply a massive contango.
And lots of oil sitting out on tankers that there's no storage for.
I mean, you'd start to see cash discounts to the screen, of just, dollars. If
Right.
really there was no takers in the
Right.
spot market.
What a great perspective.
Then you'd see a glut. But just this general conversation of inventory levels being high, I need to see some new evidence. And the new evidence would, maybe mean that this inventory picture starts to look different. I mean, just even prior to this week, again, I haven't typed the number in yet, but we have drawn inventories down now to below last year's levels slightly, in most cases. So now let's see. We have never gotten to the dire scenario that really was initially proposed, that we would run out of storage.
Yeah, because there were all kinds of stories about oil tankers not having a home for the crude. They were just sitting out there in the sea or in port and couldn't unload it. So,
and I mean, that may be true. That may be true, but we didn't see a lot of fire sales because basically the entire curve moved down to meet that.
Okay.
So anyway, I go into so many different aspects of this in order to put my story together. And currently what I'm seeing, especially, I'm sure lots of people have looked at what's going on in gasoline this week. Now that would be an example of an actual real shortage versus perceived. And meaning that there is some issues with refineries on the East Coast. And you've seen the front month RBOB crack, I think it's like almost $21. It's just gone nothing but straight up. And you can see that even here just in the last few days, right? Just the front of this RBOB curve moving up.
Yeah.
And that's really, yes, we have oil ready to go. We have it sitting in tanks and we can process it. You know, what we don't have is gasoline and heating oil, you know, sitting there ready to go in the same manner, right? So if what you look to see is that these products start to lead the whole market higher.
How about oil shares? You know, like I've noticed a relationship between miners and precious metals. Is there a relationship between the shares and the underlying commodity where the shares, after you could get an idea based upon share strength or weakness, what's going to happen to the price of energy?
Well, I think you're talking about equities. Is that what you mean?
Yeah. Yes.
I mean, there is a general case to be made for watch what refiners do versus producers.
Okay.
And if crack spreads get wider, right, and they, you know, get more supportive. I mean, I think now the front month RBOB crack might be at the highs of the year.
Right. So you buy the refiners then.
I mean, I'm not making that recommendation.
Oh,
but
I know, but that's what it would imply.
Correct.
That they'd outperform. Okay.
Correct. Yeah, and really, I think, you know, is this product spread scenario that's happening right now a one-off based on individual outages and issues, or are we actually hitting a little bit more of a trend, right? I mean, we've drawn down some inventories. We only have a fixed amount of refining capacity. I mean, that story is the same. But if you start to see that play out, I mean, typically the gasoline spreads start to dwindle a little here as we get, you know, beyond the August contract. And then the heating oil cracks start to pick up, right? Because then you start thinking about winter. And really at the moment, they're both fairly strong. And that's not one for one price correlated with crude oil, but it is a leader and is something to watch. And certainly if those collapse next week, then back to the drawing board.
Okay, I just have a couple of questions from the community. One is, Brynne, do you see sub $40 WTI?
I mean, let's say if I don't look at it in a bubble. So that would mean gasoline would be what, like $1.25 or something? Yeah. I guess I can't get that bearish on gasoline, which is why I'm not that bearish on crude oil.
Okay, and there's one more macro. As renewables and electric cars become more mainstream, will the price of oil become more stable or more volatile, in your opinion?
Well, that has a long lead time to it, and I would say there's a future state where if we have kind of disincented producers of gasoline, right, for cars, you might have a volatile scenario because you have less producers for those who still need gasoline, but we're talking way out in the future. In the short term, you know, it's not something I worry about.
You don't think about it, yeah.
I'm not, I know it's there. I know it's happening. I feel like I haven't seen anything that's changing overnight.
Yes. It happens stealthily over decades, if it happens.
Well, yeah, I mean, the electric utilities are a whole, I mean, I don't believe everybody will want to be dependent on electric utilities for their fuel source.
So buy solar?
Well, I mean, don't buy solar from a utility, right? Yeah. I mean, you do solar off grid, great, but I liken solar panels today to like the first calculator, like the first IBM computer calculator in a big massive room. Like I'm not putting that on my roof. Like I'm gonna wait till it's, you know, like
miniaturized.
Right, when it's just the little one that's at the end of a pen. That's when I want it. I don't want my whole roof, you know, stuck with the first ever computer.
Brynne, what a great job you did today. Was I right? Did you enjoy yourself here? Because the community has learned a lot about the fundamentals of oil trading from you, and I want to thank you for edifying our community and, you know, taking the step to go live. You're a natural, and may I from now on call you my trading warrior sister.
For sure.
And really hope that you have continued success throughout the end of the year, and perhaps we do this again sometime down the road.
Definitely. I enjoyed it, and you know, I always it takes me a little bit longer to get to the point because I always feel like I'm doing a backstory. So you know, maybe next time I'll get to.
It was fine. Everyone, and you don't have any kind of business model. You just, you know, where you teach people, or do you sell research or anything like that, Brynne?
So I publish fairly weekly fundamental analysis through the label, The Fundamental Angle, and it's published at Martin Chronicle. And so people can go sign up and receive all of that, or they can go to thefundamentalangle.com. I just put out a big report decomposing or analyzing the Mexico oil deal. So if anybody wants to go take a look at that, you can get it through LinkedIn. And the Twitter handle is actually Brynne K. Kelly.
Brynne K. Kelly. Okay. Yep. All right. Well, everyone, I think that's going to be a great report to read, especially for you peso traders. So thanks again, Brynne. Have a great week, and I appreciate your time and your insights and views, and I learned from you today. Thank you.
Excellent. Thanks for having me.
All right, Brynne. That's it for me today, Face. Remember, don't just count your pips, count your blessings. See everyone tomorrow. Adios.